Okay, it is 9:05, so we can start. We are going to continue with decision making. So at this point, we have completed 3 out of the 4 decisions, and we are actually, that's not true. We haven't completed this yet. So we're going to finish our constrained resource problem, and we'll, as I did the other day, kind of give you some little twists and turns and things to think about other than just that straightforward problem. And then we still have one more decision after this one, and then that is whether you should drop a segment of the business or keep it. So we're looking like we're in really good shape for our exam, which is going to be a week from today. I don't have any details about it. So as soon as I do, I will, like I did last time, under the exam 2 folder, I will post the instructions. I will email the instructions to you. But remember, follow along with the syllabus. And don't forget that there is case number 2 that comes the day or the class after that. Right, so the case number 2 is a decision-making case. It is up there for you to look at. So as you're studying, if you want, you can kind of take a look at that. Remember, the idea with the cases is that it's like the take-home portion of your exam, right? So it goes into more depth, but the concept should be there, right? So it's very different from the first case. This one is numbers where you're going to be calculating the right answer or the wrong answer, right? So not due until a week from Friday, but again, as you're studying this stuff, it doesn't hurt to kind of throw it in. It'll help you to kind of think through things, I think. Okay, but anyway, so I will give you more information as I get it with that exam, but it is a week from today. So we're going to finish up constrained resources today. So remember, a constrained resource means that you have a bottleneck. You are at capacity. You cannot get another unit produced and sold, right? And so the idea here is we're setting the production schedules in a way that will bring us in the most money. So we know back from cost volume profit analysis that when we are picking the products that we want to produce, or the ones that make us the most money, are the products that have the highest contribution margin per unit or the ratio, right? That tells you you get more from those sales dollars. So instead of looking at contribution margin per unit or ratio, now what we want is contribution margin of the constrained resource, right? So we talked about it's Friday, it's 4 o'clock, right? And somebody comes to you and I have back orders, which product do you want me to make? It's not necessarily the product with the highest margin per unit. It's the one that is going to give you the best return of that machine time. Which product will give you the highest margin per machine hour or per machine minute? If your constraint would be materials, maybe you have a material that is pretty scarce and you need that material in the products that you're producing. I would start again with the contribution margin per unit, but then it would be in pounds of material, right? So which product am I going to get the best use of that material? So the constraint, the idea here is, like I said, and this is what we worked on last class, first you're going to have to get the contribution margin per unit, and then what you need is the contribution margin of the constrained resource. And this was machine A1. And so we said, even though the per unit number was 15 and lower than product 2, because I could make twice as many of them with that machine time, then I could see that I was going to get a higher contribution margin per minute of that machine time. So once I've identified that product 2 is the one that I would want to make, remember, you don't want to just continue to make it. You want to look at that demand and you want to make all of that demand. But then as soon as you're done with that demand, then you're moving on to the next product with the second highest contribution margin of your constrained resource. So this problem said we had back orders or demand of 2,200 units, and we know I'm making product 2. So I know that I need 50 or a half a minute for each one of those units. So I know that I'm going to need 1,100 minutes to make all of product 2, which is what I want to do. I'm making the most money there. The amount of minutes that I had available for that machine were 2,400. So I know I'm using as many minutes as I need to make product 2. And what I'm going to have left would be 1,300 minutes. And since it takes 1 minute to make product 1, which is what I'm moving on to now, then I know that I should be able to make 1,300 of back orders for product 1. Looking at how much you're going to make with this production schedule, now you can go back to that contribution margin per unit, because this is how much you're going to get from each one of those units that you're going to be producing and selling. Okay, so that's where we left off last class. So what I just want to do is show you just some slight variations here that I see, that I know that have confused students in the past. So what I want to do is give you one more example. Actually, I'm going to do 2 more examples, but here's another way of looking at this. So this is, I don't remember what company this was, Union Bay. So they make shirts and jeans, right? And so again, I have a constraint. So the sewing machines, both of these products have to be made on the same sewing machine. And I only have 2,000 hours of capacity time for that sewing machine. So I have back orders for shirts and jeans. How do I decide which one of these products is what I would want to produce first? Again, first, you're going to have to calculate the contribution margin, either per unit and ratios. And you know that without a constraint, shirts are where I'm making the most money, right? But what I also know is that I don't want to look at contribution margin per unit. I want contribution margin per machine time, right? In this case, it's going to be hours, right? So here's the tricky thing that I'm telling you to look for here. In the past, or the last example, I told you how much time it takes to make each one of those units. Another way of giving you almost the exact same information is telling you I can make 10 shirts in 1 machine hour, right? So if I'm telling you it takes 0.1 hours, that means I'm taking 1 hour and dividing it by shirt, so I can make, so each one takes 0.1 hours. It's just another way of giving you the exact same information, right? So here, just like in the last problem, I said it takes 0.05 hours to make a pair of jeans, and you can make 20 pairs of jeans in an hour, right? It's just another way of giving you the exact same information. Okay, so I can see here, I'm able to make twice as many pairs of jeans, very similar to what we just looked at, right? So if I am next moving to contribution margin per machine hour, you would either, if I told you, or if you wanted to use the units here, I know that I'd make $180 for that machine hour if I'm making shirts, right? Because the contribution margin per unit is 18. But when I'm giving you the units that you can make, you can multiply that by the units to get the margin you're going to get for that machine hour, right? And same thing here with jeans. You have a margin of 12, but you're able to make 20 of them. So the total margin you're going to get is $240 per machine hour. This is how we were doing it in the last problem, right? So you are looking at, if I give you the number of units that you can make in that hour, you multiply by units. If I give you the amount of time it takes to make each unit, then you're going to divide by that time. You're going to get the same answer. And the answer is still going to be make jeans, because you're going to get 240 versus the 180. So what I'm just telling you is use the correct operational sign here, right? If you're given units per hour, then you're going to take those units and you're going to multiply it by the contribution margin per unit. If I give you hours in that unit, then you take the contribution margin and you divide it by that amount of time. Either way, you're looking for that contribution margin per machine hour. Okay. Does it make sense? Okay. All right, let's do one more problem then. Let's try this problem here. Paladin Woodworks manufactures canoe paddles and baseball bats. This month, the company has orders for 3,000 paddles and 1,000 bats. And the company only has 1,000 machine hours available. How many bats and how many paddles should Paladin make? All right, so let's do this together. What's the first thing that you're thinking about doing here? Michael?
Finding the contribution margin per constrained resource.
Okay, well, first of all, here in all of these problems, I've given you the contribution margin per unit, but that may not always be the case, right? So remember, if you're going to be doing this problem, it is your selling price minus all of your variable costs, both product and period, right? Your contribution margin per unit is selling price minus all variable costs per unit. Right, so you may need to just do that. In these cases, I've already done that contribution margin per unit for you. But yes, the next step is, if I didn't have a constraint, I know I'd want to make paddles, right? But now I have that constraint. It takes me 1 hour on the machine to make a paddle, and it only takes me a quarter of an hour to make the bats. Right, so instead of contribution margin per unit, what I have is contribution margin per machine hour. And this is telling you which product is going to be what you focus on first. So I can look at this, and because I can make 4 times as many bats as paddles, I know I want to start with the bats. Right, so I look at what I have back orders of 1,000 bats. And so what's my next step? What's your thought process here? Jacob?
I would then use bats to say the higher contribution margin per hour and see how many I can make.
Okay, and how many could you make?
Be 1,000.
Okay, yeah, you have 1,000 bats, but you're going to be able to, are you going to be able to make all 1,000?
Yeah.
Yeah, because you can see, I'm going to make all 1,000 bats, and if I do, it takes 0.25 hours to make each one. So what that tells me is I had 1,000 hours and 250 hours, or what I'm going to need to make those 1,000 bats. So what I'll have left is 750 hours, right? So you take your constraint, you subtract out how much you're going to need to make that first or highest contribution margin of the constrained resource, and then you're moving on to the next product. And the next product is paddles. So how many paddles am I going to make? Well, it takes 1 hour to make a paddle, and you have 750 hours left. So you'll be able to make 750 paddles. Right, so even though you have back orders or orders for 3,000, you want to start with the bats. And then when those are done, you're going to make as many as you can. In this case, it's only going to be 750. Everybody good with this? Okay. All right, so we're going to move on to, oh, not yet, recap here. So the decision, how do we allocate that scarce resource across all of your products? So remember, the scarce resource or your constraint, you're looking for the contribution margin of the constrained resource, and then you look at the demand for your products. Qualitative factors, customer preferences for products. So it may not always be about you making the most money. It could be that that customer really needs the bat instead, or the paddle instead of the bat, and you need to satisfy the customer. Watch out for the contribution margin per unit. I know that you are focused from exam 1. Just remember, it's not about that when you have a constraint. You need to make the most of that constrained resource. And then you're going to make the product with the highest contribution margin of the scarce for constrained resource. And that is the template that I put up for you. So a reminder that you're not looking at contribution margin per unit, that you're looking at that contribution margin of the constrained resource. Okay, now we're moving to the last one. Dropping or keeping or eliminating a segment of your business. Okay, How do we know when when it's time to add, or we're going to be talking about dropping a portion of your operations? Well, usually when something isn't performing well and not bringing in a lot of money, then that's when you're going to decide whether you want to get rid of that segment of the business, right? As I'm saying, resources are limited and managers need to use them wisely to generate the best net income. So if a product or a store or a service location is not making money, it's time to decide whether that segment should be eliminated. Okay, so first, I just want to talk about segment reporting or segmented income statements. So before we even get into the decision, what you need to understand is how income statements are segmented out. So you have, well, usually you have really large companies like, we'll use Sears as an example, right? So Sears was having trouble, and so you saw them closing store after store after store. So how did they decide what store they were going to close? Well, what they did was they took their income statement and segmented it out by stores. And then they were able to see which store was performing better or which ones were performing poorly. And that's how they decided to eliminate the stores. Some companies are going to segment by stores. Some companies are going to segment their income statements by sales territory. Apple segments by territory, right? And if you were to look in the financial statements for Apple, what you will see is that the way they run their business and then the way they segment it out is the territories that they're in and which territory is performing better. And so when they're making their analysis, they're looking at territories. If you are Pepsi, right? Pepsi is another big, huge parent company. How do you run a parent company like Pepsi? They segment by division. So they obviously have Pepsi in the soft drinks, but they also own Tropicana and they own Gatorade and they own Frito-Lay, right? And so they segment their income statement out by division. And what you're going to see, and we're going to get into this when we do performance evaluation, we're coming back to these segmented income statements. But the idea here is if a company like that can't run itself without segmenting down, then what you're going to see in the financial statement, it's required now by FASB that they have to show you their segmented income statements as well, right? The idea is if you can't run the company without segmenting it out, then how do you expect investors to make an investment without seeing how you're segmenting your company? So you're going to see if you pull up these financial statements, and it's a fairly new pronouncement, so it's in the notes, probably towards the end of the notes, where they show you the segmented information. So it's really key for you, even if you're not preparing these, if you're in finance or you're trying to read a financial statement, where to go and what to look for now, because that information is there for you. So for us now, we're talking about looking at these segments and then making a decision whether we should drop that segment or keep it. So we're in the management position. We're not doing that analysis just yet. That's going to come in chapter 10. All right, so what I'm telling you here is a segment can be segmented however you want to segment your company, right? It can be by store, by territory, by division. Your accounting systems are state of the art. So if you're running a company, you can call the accounting department up and say, can you break this income statement down by store? Can you break it down by product line, right? So your financial statements are going to allow you to do that. All right. There are two keys to a segmented income statement. So if I'm evaluating a segment, I want to look at two different keys to building this segment. The first one is it should be in contribution format. If it's in contribution format, that as a manager is going to allow you to look at that segment, and if it's performing poorly, then you know how to make improvements there, right? So that doesn't mean because it is showing a loss or you're not performing up to the other products that you have, it doesn't mean that you can't do your cost volume profit analysis and have a sale or change your packaging, right? So there's still things that you can do to make your improvements there. So contribution format is a good key for you. And then the second one, and this is new, is that your fixed expenses need to be broken down now into direct fixed costs or common fixed costs. Direct fixed costs are costs that are directly caused by that segment. So you might see the terms as traceable to that segment, or directly traced to that segment, or avoidable. Actually, if you are looking at dropping that segment, which we will get into. But the idea is your direct fixed costs are caused by the segment. So you're going to be holding that segment accountable for them. Common fixed costs are not caused by the segment, and they're not going to be part of your analysis. Right, so let's talk just a little bit more about this, right? So you need to identify your direct fixed costs. This is sort of the litmus test I'm going to give you. If you're looking at a fixed cost and you're saying, is it directly caused by this segment or not? You can say, if I were to eliminate this whole segment, would that cost go away? And if the cost goes away, then clearly that segment is causing it, so it's going to be part of the evaluation. Okay. This, and I'm going to show you this segmented income statement. This company has two divisions, so we're going to break this company down into two divisions. They make computers and they make televisions, right? So here's the division manager for the computer division, right? So if I'm thinking this division is not performing well and I'm thinking about eliminating the whole division, this poor guy here is going to lose his job, right? So that means his salary must be directly caused by that division. This is very different from common fixed expenses. Common fixed expenses aren't caused by the segment. They arise because of the overall operation of the company and will not disappear if a particular segment were eliminated. Here's the CEO of the entire company, right? So here's the CEO that runs both, or is in charge of both the computer division and the television division, right? If you think about Pepsi, you have the CEO of the entire company, the corporate company, but then you have the division managers of each one of those divisions, right? So here's the CEO of the entire company. It is his job to decide which one of these divisions maybe should be dropped or kept or improved, right? So this CEO is not going to lose or take a salary cut because they decide that they want to get rid of that computer division. So if that salary is still there, even if you eliminated that whole segment, then clearly that segment of the business isn't causing that cost. And so how can you hold them accountable for it, right? They're not causing that expense. Which brings us to a new term here, segment margin. This is not contribution margin, so it's a little bit different. The segment margin is computed by subtracting the direct fixed costs of a segment from its contribution margin. So you start with contribution margin, then you subtract out all of the fixed costs that are directly caused by that segment, and then you're going to get the segment margin, right? It's the revenue and expenses that would disappear if the segment is dropped, and this is what is relevant in your decision. So basically what you're saying is, here's the segment. The revenue, if you start with contribution margin, then you know that's the revenue that is coming in from that segment. And then if you are starting at margin, you already know how variable costs work, right? They are coming right along with those sales dollars. So instead of, again, saying I'm going to lose the sales and I'm going to avoid the variable, you can just start at margin. Margin is what you are going to avoid because you are dropping that segment. So if I'm looking at the segment margin, I'm saying, here's the profit, the margin that's coming in from that segment. And if I deduct the direct traceable fixed expenses, then I'm seeing what that segment is contributing to the company as a whole. Overall profitability. All right, so take a look at this segmented income statement. So here is that company, I think it was Weber Company, Weber Inc. There's the two divisions, and then here's the company as a whole. So the CEO of this company looked at the net income and he said, you know what, this is not what I expected. It's much lower than what I expected. So he called up his friends in the accounting department and he said, can you segment this out by the two divisions? I want to see if one division is performing poorly or not up to what I thought it was going to be, right? These big companies, you need to break them down in order to get more information. And so as you break them down here, notice that, first of all, look at the format. It's your contribution format, and then the segment margin. In this case, I segmented out by division, so they're calling it a division margin, is what is going to tell me whether this segment is profitable or not, because I'm looking at the revenue and the expenses that are directly caused by that segment. So I can look at this television division and I can say $60,000 is what is coming in excess of revenue over expenses only caused by that segment. And then same thing with the computer division. When I look at segment margin, I know that the computer division is contributing $40,000 to help contribute to these common fixed expenses. Right, does that make sense? And you're going to see right here, this is going to be really easy for you. So I can say, I'm not happy with the computer division, right? This is low for me. Maybe I should drop the computer division. And you're going to look at this and you're going to say, nope, the computer division is bringing in money. It's profitable, right? I'm making 40, this computer division, revenue over expenses caused by that division is bringing in $40,000 to this company as a whole. If I eliminate it, I'm going to see my net income go down by $40,000. Okay. Everybody good? All right. So what is what's relevant to the decision here? So you want to look at all the direct costs associated with the segment, right? You're looking at the variable costs. You know, variable costs are caused by that segment because they go right along with those sales dollars, right? And then you're looking for direct, avoidable, fixed cost directly traced to the segment. I'm throwing in all of those terms so that they are all going to jog your memory when you see this, right? They are directly traced to the segment. They would be avoidable if you eliminated the segment, or they could say that they are traceable to that particular segment. All of those little terms here are telling you that that's what you want to deduct from margin to get to the segment. They are directly caused by that segment. Revenues minus variable minus avoidable fixed expenses are going to give you your segment margin, and that's what you're looking for, right? And watch out for those allocated, common, assigned fixed expenses. So more little terms that I'm trying to draw your attention to. Those common fixed expenses, the ones that aren't important, guess what? When you ask your accounting department to segment that income statement out, they don't do that for you, right? When's the last time you saw a financial statement where they pulled out common or traceable? That's your job to do that. And so you're going to look at all of those fixed expenses and you have to decide then which one is caused by the segment and which ones aren't caused by the segment. So the accounting department has to account for all of the costs. So what they do with something like the CEO's salary is they'll look at it and say, well, it's not caused by the television division and it's not caused by the TV division, but I'll look at the division that can handle it more. Usually they allocate them based on some arbitrary method, like which sales dollars are coming in that can handle it better, or space occupied in the factory, right? So you know, as a manager, that's fine for the accounting. They have to account for all the costs, but you know that those costs need to be pulled out when you're making a management decision, like evaluating this segment. So allocated means that the accounting department has taken a common fixed expense and allocated it by some arbitrary method, right? Common, assigned, those are all terms or keys for you. Those little red flags saying that that cost has been allocated by the accounting department and isn't caused by that segment. You're going to want to pull it out. Manna.
So are allocated, common, and assigned talking about the same fixed costs, or are they different?
No, I'm just giving you terms that will kind of jog your memory and say, oh, because it might not say the common fixed expense. It might say the cost that were allocated or assigned to is telling you then that wasn't caused by that segment. That's the accounting department at work just trying to figure out where to put it. Yep. Just like here, avoidable, direct, traceable, those are all your little clues that that is actually caused by that segment, and you want to include it in your segment margin analysis. Okay, so I put this problem in here to just kind of give you a little practice with segmented income statements. So here it says, Shannon Company segments its income statement into its North and South divisions. The company's overall sales, contribution margin ratio, and net operating income are $500,000, 46%, and $10,000 respectively. The North Division's contribution margin and the ratio are 150%, 150,000, and 50% respectively. And the South Division segment margin is $30,000. And the company has 90,000 of common fixed expenses that cannot be traced to either division, right? So basically I looked at this problem and I thought, this sounds like so much fun. It's like a Sudoku puzzle, right? So if you know how to set up a segmented income statement, you can plug in the given numbers. And then from there, I could ask you any of the missing numbers, right? So this is just going to require you to understand how a segmented income statement works, right? So if you're looking at this problem, I give you company as a whole sales, the contribution margin ratio, company as a whole, right? Common fixed expenses, the net operating income. So could you tell me what's the overall segment margin of both divisions, or the segment margin of the Northern Territory, right? Any of these missing numbers could be your multiple choice question. Actually, let me see if I have this up. Yep, I do. So we have time, let's play. So why don't we go through, is there a question up?
No.
Oh, I'm not sharing,
not
right?
sharing.
That's gonna be helpful if I do that. This one. All right, so what I just did, I had this template up for you under the Chapter 8 folder, but instead of having you do it, I think we'll just do it together. So so what I want is so this can be in class participation. Let's play Sudoku, and then you can fill in the blank as you see fit, right? So who wants to start by looking at this information to fill out something that's missing? Andrea, you want to start?
Yeah, I think that variable expense are 230.
Okay, variable.
Wait, I'm mixing up the, wait.
Yeah.
Let me just check, because I'm mixing up I have to remember the number of it, so.
So I know how you got, you got 230.
For the contribution margin.
Yes.
And the variable is.
All right, don't take somebody else's little point away.
Sorry.
So yes, so what Andrea is saying is that the margin as a whole will be, oops, where'd it go? The margin as a whole is going to be 230,000 because she understands what contribution margin ratio means. Right, so if this is 46%, then that means that this contribution margin is 46% of overall sales, which is 230. Okay, good. All right, don't chat me answers. I want you to give it to me verbally. So Mary, what do you want to put in next?
So the total variable expenses are 270,000.
Okay, perfect. So if you know margin and you know sales, then you know that sales minus variable is going to get you to contribution margin. Diego,
The Northern Territory sales are 300,000
okay, and you know that how?
because the contribution margin is 50%.
Right. So you know what, that this is telling you that this 150 is 50% of this. So that has to be 300. 10.
I think the direct fixed expense and their total should be 140,000.
Okay, so how are you getting that?
I use the contribution margin minus the common fixed expense.
Okay, so direct would be contribution margin minus direct will give you segment margin. All right, so hold off on that. So I'll come back to you for direct fixed. Annabelle,
The variable expenses for Northern Territory is 150,000.
okay, perfect. Matthew?
I was gonna say the exact same thing that she did.
Okay, Louise?
Would the Southern Territory contribution margin be 120,000?
All right, so you're going this way, right?
Yeah.
Okay, yep, so you can do that. So what Louise is saying, like I said, it's like a big Sudoku puzzle because you're taking company as a whole and you're breaking it down into the segments. So if the company as a whole margin is 230 and 150 is Northern, then the rest of it has to be from Southern, right? And that would be, what did you say it was?
120,000.
120. Okay, if you've already answered, put your hand down, right? So give somebody else a chance. Jiaying,
Would the sales for the Southern Territory be 200,000?
yep. Same idea, right? If you're looking at total and 300 is from Northern, then the rest of it has to be from Southern. You guys are all set for today. Oh, go ahead.
You as well.
Why is it 120,000?
80.
Oh, okay. Yeah, I'm just going by what she's saying. Okay, yes. So if this is 230, that's 150, that has to be 80. I know what she's doing, but I think she's reading it from the wrong line. Okay, Michael?
The direct fixed expense for Southern Territory would be 50,000
Okay, for which territory?
for Southern Territory.
Yeah, so if this is 80, then which is the correct answer, and then the segment margin is 30, then you know direct fixed minus, contribution margin minus direct fixed would have to be 50, if that is to be true. Okay, Karina,
The variable expenses for Southern would be 120,000.
that's the 120. Right, so you could either get that by working this way or working this way. Oh, actually, I think you answered it right. I think I just put it in the wrong spot. Okay, Stephanie?
Sorry, I was gonna say the same thing.
Okay, do you want to pick something else? What's the ratio for the variable expenses? Okay, that's all right. I'll move on. Emily?
I think it's use the I think it's use the 217,000 to divide no use the 150,000 to divide 270,000.
Oh, okay. Are you trying to get this ratio?
The next ratio, the Northern Territories ratio.
Oh, Northern Territory ratio? All right,
of
so,
the variable expense.
right, and what would it be?
Uh,
Don't even
it
do
would be,
that. Right, so let me just help you out a little bit here. So you know, sales divided by itself is always 1 or 100%. So if we know that this is 50, what is the variable percentage?
50%.
50, right? So it would be 150 divided by 300, just like it's 150 divided by 300. Everything is always a percentage of sales, but once you know one, you know the other, which is why I was telling Stephanie, actually, let me go back to Stephanie. What's your variable percentage here?
I got 54%.
Right, if this is 46, that has to be 54. Andrew,
The contribution margin percentage for Southern Territory would be 40%.
okay, and Jada?
The variable expenses would be 60%.
Okay, Chow?
Is the segment margin would be 100,000?
Okay, yes. So what she's doing is she's now back over here and working her way up here. So what number minus 90 is giving you 10,000? So working backwards, this has to be 100,000. And now it should be easy to fill this in. Somebody that hasn't said anything yet? Utah?
The direct fixed expense of the total company will be 130,000.
Perfect. Which means what's the direct fixed for Barui? Is that right?
Yeah, the direct fixed expense for the North Territory is 80,000.
80?
Yes.
Yeah. Has to be if this is 130, which is the total. And then Andy.
It'll be 70,000.
Okay. Perfect. All right. So as I said, Manna.
Could you explain like a segment margin?
Yep. Segment margin is what you would have, and this is the total of these two, which we didn't have, right? So what we did have though is that net income was 10,000, and then the common fixed expenses were 90. So if I did have this number, I would have subtracted 90 to get to 110. So I just reversed that. I took the 10,000 plus the 90, and I got to 100.
And what's the 50 given?
The 50 for which one?
50,000 for Southern Territory.
No, but what we did was we had the total margin here, so we were able to back that out from the other information.
Yeah.
And so we knew this was 80 and 30 was given.
30 was given, okay.
Yeah. Okay, so just to kind of go through, just for fun, because we have time. So this is the kind of thing that you could possibly see, and I put this up for a reason because I have seen this, and you'll see when you start to do practice problems and practice exams, that this is one way of making sure that you understand that this is how the segmented income statements work. Okay. Right. Any questions on this? Everybody's good? Okay. I can't just change this myself. I have to stop share. Go back to. Okay. All right. So now that we know segmented income statements, now we have to make our decision, right? Just you have to decide whether you want to discontinue a particular segment, department, store, whatever it is, product line, however you've segmented it out. And the template that I'm giving you is to compare your lost contribution margin to your avoided or saved or direct fixed expenses. Basically, your thought process is what's relevant here is if I eliminate or drop this particular segment, the thought process is what do I lose and what can I save? And if you can save more than what you're going to lose, then your net income will go up. But if you're going to lose more than what you save, then your net income is going to go down, right? So you can start with the margin. That's what's coming in from that segment. So what you're saying here is, if I drop this segment, this is what is no longer going to come in from the company, right? That's the margin that is currently coming in from that segment that will go away if you eliminate that segment. And then what you need to do is look at all of those fixed expenses and figure out which ones can be avoided, right? Which ones can you save by eliminating that segment of the business? Okay, so here is Garnier. They make shampoo, styling products for your hair, and skin moisturizers. So the Garnier CFO is concerned that the company's net income is not as expected. So she asked the accounting department to segment the income statement into their 3 product lines. So when they do that, you can see that here's the company's net income as a whole, broken down into its 3 different product lines. You can see that skin moisturizers seems to be having trouble, right? Your decision is going to be, should you drop this segment of the business? And if you do, will net income go up or down, and by how much? And if you look at this and say, yep, drop the skin moisturizer because you'll see net income go up by $38,000. Once again, you probably have just lost your job, right? Because when you're looking here, you're just looking at what the accounting department has given you, which is a great start. But this does not mean that these are all real dollar savings, right? So what you're going to do is you're going to say, if I end up dropping skin moisturizers, what am I going to lose? So you know sales will go away, but you also know that these variable dollars are being caused by those sales dollars, which is why I can start with margin. If I get rid of skin moisturizer, this product is bringing in a margin of $124,500. That will no longer come in if I eliminate it. What I need to do now is look at these fixed costs, right? Again, the accounting department does not tell me which ones have been allocated and which ones are directly caused by the segment. So I'm going to have to give you some more information here in order for you to tell me which of these fixed costs are actually going to save me real dollars. Okay, so you want to say, is the contribution margin positive or negative? If it's positive, then you want to continue with your analysis. If it's negative, then you know that this product has to be dropped. All right, so I already know that the margin is positive. And now what we're looking for are those avoidable fixed expenses, right? Fixed costs that can be eliminated as a result of discontinuing the product, or also known as direct or traceable fixed expenses. Unavoidable fixed costs are the costs that will continue to be incurred even if the product line is discontinued. Those common allocated costs, they are not relevant. They're there if you keep the product line. They're still there if you drop the product line. Nothing differential, right? I'm looking at what's going to be different for me if I drop this product line. Okay, so here's the information that I'm giving you about all of those fixed expenses. If we drop the moisturizer division, the manager supervisor in the factory will lose her job. Her salary is $20,000. And the sales associate that works directly in the moisturizing department will also be let go, and his salary is $30,000. Is that avoidable? Directly traced? Yes, this is going to be relevant. If I get rid of this segment, I'm saving $50,000 here. Eliminate it. All right, so we no longer need to lease the equipment that makes the moisturizer. The current cost of leasing this equipment is $12,000 per year. Is that avoidable? Yes, right? If I'm no longer making moisturizer, I do not need to lease that machine. That is going to save me $12,000. Right, we no longer need to advertise this product, so advertising will decrease by 15,000. Avoidable? Yes, right, that's real dollar savings here. Okay, depreciation expense is based on assets directly related to each department. If the line is dropped, there's no other use for the equipment to make the moisturizer, so it will be donated to a charitable organization, and the depreciation expense for this equipment is currently $17,000 per year. Okay, is it going away? Is it traceable? Is it relevant? I can't see who it is.
It was Matthew.
Matthew,
I would say no.
why?
Honestly, because I just remember in like the last class, you said anytime we talk about depreciation, it's a sunk cost.
Correct. Am I going to save any money here? So here's a little trick. It is traceable to this division, but it's still not relevant whether you're dropping that segment or not. You're not saving any money. When did you buy that equipment? Why didn't you buy those? What are we looking at? Whatever it is that we are depreciating. We bought it in the past. Depreciation is never relevant. So even though I can trace it directly to that particular product line, it's not relevant. There's no money savings there, right? And then all of the other costs are common fixed expenses that were allocated to the department based on sales revenue. So if you thought your net income was going to go up by $38,000 and you drop that moisturizer division, what you're going to see is that your net income would actually go down by $47,000. Lost margin compared to all of the avoidable, relevant, direct, traceable, fixed expenses. Michael.
So like the conclusion there is keep it even though it looked at first.
Yes, so the question is either going to say you are worse off to drop it, you're better off to buy to keep it. So just kind of watch the wording when you're answering that question. But looking at this, you don't want to drop it. Your net income would go down. Okay, all right, so we're going to end here and we will have more fun on Friday. Bye, Emily.
Professor? Yep, so I have something to tell you that I won't be able to make it to class on Friday because I am moving back to Korea that day. So my flight is on Friday.
Okay, so that's fine. Make sure that you are going to watch that. So you're moving Friday?
Yeah, I will do that.
Korea? Okay, so if you can, watch that recording within the 24-hour period. So so that if we do any in-class assignment stuff, you'll be able to get that in.
Okay, but yeah, but I don't think I'll be able to do that in 24 hours though, because.
Right, so that's why I'm saying if you're going to Korea, I don't know if you're going to be able to do it either. So just let me know on Monday if you were not able to.
I'll be able to do it before Monday for sure.
If it's closed, then email it to me, so at least you don't, I haven't even decided what we're doing yet Friday. So if there is something, I may have lots of questions and there may not be an assignment, but if there is one, just let me know. You can always email it to me if we.
Okay, but I won't be able to do the poll questions if there's any, right?
No, the poll questions are, there's no way to make those up. Those are whether you're here or not.
All right, I'll let you know. Okay. Thank you.
I just had a quick question before Mike goes. Is that template that we went over today on, like, not Blackboard, Professional Tools? The
Yes.
Excel one? Okay, cool.
Yes,
Just wanna
yeah.
look over it again. Thanks.
Hi, Michael.
I had one question on like the slide ahead where it says the other considerations for discontinuing a product.
Okay, let me go back. Sorry.
All good.
Okay, so back here.
No, it's one more ahead than what we did. I was just looking at like over the class slide. Yeah.
Oh, okay.
I
All
was
right.
confused on that first part. It says the loss of contribution margin on those products, not sales.
Well, right, we haven't done that yet. We're gonna do that on Friday.
Okay.
Yeah, so the idea here is it's a complementary effect. So if you got rid of one of the products, then you tend to see your other product sales go down as well. Because, I mean, if you are a department store and you stop selling housewares, people were coming into housewares in order to buy a pan, right? And as they were walking by cosmetics, they saw, oh, you know, I didn't even know that I needed that, or I like that, and I'm gonna buy it. So what I'm saying is you have that complementary effect. So a lot of times if you drop one product, you're gonna see sales in other products go down. But
Okay, got it.
We're gonna cover that on Friday.
Okay, great. Thank you very much.
Gotta love when they're looking ahead. Thank you.
No problem.
Good, we got a lot of participation
Oh, yeah,
today.
that was good. At the end, it was just boom, boom, boom.
Yeah, good. That's good, because then you get the ones that aren't really confident starting to get confident.
Mm.
Awesome.
Oh, okay, yep.